Hey everyone, and welcome to the Fiscal Philosopher. Today, we've got an amazing video for you guys about how to pay down debt and how to pay it down fast. If you're new to the channel, please like and subscribe. It helps us continue to make content like this, breaking down financial as well as economic concepts, as well as giving you advice on how to spend, save, and invest your money wisely. Let's get right into the video. Before we talk about how to pay off your debts, we first must consider what makes a good debt and what makes a bad debt. While there is some truth to the idea that all debt is bad, what they are really trying to say is that all debt is dangerous. Simple interest, by its very definition, means that you can end up owing more than you've ever actually paid. Good debt, on the other hand, is something that, even though it considers this risk, could pay off in the future. Consider the purchase of your first home. You are agreeing to get $400,000 in cash from the bank as a mortgage. In return for that $400,000 in cash, you will pay $800,000 over the next 30 years. While that sounds like a bad investment, the value of your home is expected to rise even more than that in the next 30 years, making this good debt. Consider credit card debt on the other hand. An $80 charge on your credit card could end up costing you hundreds, if not thousands of dollars over the course of your lifetime if you don't pay it. Especially when most of the things that you buy on a credit card aren't things that hold their value. A good middle ground can be auto loans. While paying interest on something that loses value over time, like a car, can be considered a bad investment, consider what we've mentioned in our other video about budgeting. A car could be an investment in your ability to earn a wage. Consider, if you have a $350 car payment that you need to get to your $5,000 a month job, that's a great investment. The problems lie, on the other hand, when someone finances a car way out of their budget. And this isn't even more money than they bring in, this is just more than the return on the investment. Consider, if you had to spend $900 a month to earn $3,000, or you had to spend $325 a month to earn $3,000, which is a better return on investment. A good way to protect yourself from owing more on the car in the case of an accident is gap insurance. Gap insurance for a few dollars a month agrees that they will pay off the remainder of your auto loan in the case that your car gets totaled, leaving you with complete freedom if you total your car. But again, this is all only true if your car is earning you money overall, not the flip side. All this aside, there are two main ways that you can pay off debt. One focuses on your mental well-being, and the other focuses on the math. It's important to remember that personal finance is more behavioral than it is mathematic. For instance, if something works better for you from a mental point of view, even if it could cost you a couple dollars, isn't a couple dollars worth your mental health? The first way is the debt avalanche. This saves you the most amount of money. The first step is to figure out how much you can pay each month. It's important to remember that every dollar of debt you pay off is a guaranteed rate of return in the future. For instance, if you have credit card debts at 26%, paying them off now is a 26% return in the future. The next step is to list out everything you owe, from credit cards to student loans, not your home mortgage, but everything else, every other debt that you owe. Sort them from the highest to the lowest interest rates. If you don't know what your interest rate is, you can check your bill. By law, your creditors have to list your interest rate on every bill. Next, you're going to pay at least the minimum payment on every single debt you have. You don't want to get hit with unfortunate late fees or overage fees or non-payment fees. These can make your overall balance go up and you'll end up paying even more interest. So it's important to stay current on every single debt. The next step is to take whatever money you have remaining after you've paid the minimum payment on each and pay it towards the credit card or the debt with the highest interest rate. This will make sure that you pay the least amount in interest over the course of all the debts you have. You are getting the largest guaranteed return first. After you have fully paid off the credit card or the debt with the highest interest rate, you're going to go and apply that payment towards the credit card or debt with the next highest interest rate. This will always guarantee that you are saving the most amount of money on your debt. You are going to keep going through this process until all your debts are paid up. There are also a lot of great calculators online that will show you how much you will pay over time and how much time it will take you to pay off your debt, and even give you schedules of how much you will owe when. Check them out. The second method is called the debt snowball. It's called this because of the snowball effect it has on your mind. You start this much the same way you started the debt avalanche method. You figure out how much you can afford to budget to pay towards your debts every month. Then you start listing out your debts, from smallest balance to largest balance, from the least owed to the most owed. Then you will continue to make at least the minimum payments on every single debt every single month. Failing to do so will lead to late fees as well as interest rate hikes, which will negate any effects you will have from this method. After you have finished paying the minimum payment on every debt, you will take what you have left over and apply it to the smallest balance or the least owed. You will continue to do this until the first debt drops off completely. This will happen faster than the avalanche method because you chose to go by balances first. Of course, this will cost you slightly more in interest, but isn't your mental health worth a few dollars? You will continue to go down the line and pay off your debts, smallest to largest. This will create a positive feedback loop as you continue to pay off accounts and the smaller accounts drop off one by one. Whichever method you choose, the debt avalanche or the debt snowball, will result in you getting rid of your debts, and fast. While one will optimize your mental health, the other one will save you a little bit more in interest. But the important thing to do is to do it. If you made it to the end of the video, thank you so much for watching. Please give us a like and subscribe. It really helps us continue to make helpful content like this. Look forward to the next video.